Well, g'day guys, it's Peter Montgomery from The Peter Montgomery Show. I interview influential speakers, entrepreneurs and authors about how they become successful in their businesses and in their careers. Today on the call, I've got Zaki Ameer. He's done an amazing thing where he's created a $3 million property portfolio in 3 years with 15 properties. So welcome to the call, Zaki.
Thanks, Peter. Good to speak to you.
Now, in the past, we've spoken and you've mentioned about high rental yields and how that allows you to continue to build a property portfolio through the banks. Now, could you explain a little bit about how that works and what that means?
Okay, the way rental yields are calculated for anyone out there who isn't aware what that actually means, it basically means it's a percentage amount where you add up the total rent for a year that you'll receive from a property from, say, rental income, and then you divide that by the purchase price. And that's how you get to rental yield, which is a percentage. And what I mean by higher rental yields is basically means that the income you're receiving from that property far exceeds the expenses that you might have to incur by maintaining that property. And some of the expenses that you incur is basically usually investors have a mortgage, and that's interest repayments. It can be council rates, strata rates if it's an apartment, water rates, insurance, property management fees. So basically what I'm looking for high rental yields basically means is that the income that we receive from the property far exceeds all these total expenses. So basically in a month, maybe I might have a net positive cash flow of say $100 a month. And that to a bank in terms of financing your next property, in terms of building a portfolio and a large portfolio, means that these properties are now self-sustaining. And that's a very important matter, because what happens is majority of investors get targeted to negatively geared properties. And that basically means is that the property is costing them money to maintain, and they need to fund this cost usually from their own job or their own business. And if you continue to buy negatively geared properties, the bank at one stage is going to say, we're not going to continue lending you any further money, because of the fact that your serviceability in terms of the bank's point of view is that you can't afford to purchase any more properties. And this is why I target properties with good rental yields. It doesn't necessarily mean that you need to have high rental yields. It needs to be a balance of an overall, a good neutral rental yield portfolio so that you can continue investing.
So to see if I get this right, so in terms of, it just sounds like good business sense in general. Like if you've got more money coming in than going out, you're doing all right. So the banks are going, okay, well, everything's under control here. This is a good, sound investment to be investing in your portfolio.
That's right. And in my opinion, if you're building a property portfolio, more than investing, it's actually you're running a property investing business. And you have to treat it just like any other business in terms of cash flow.
Excellent, man. Excellent. Thanks. Well, I've learned heaps, man, just in this one little tip. Thanks so much, Zaki.
Thanks, Peter. I'll talk to you soon.